Hello, guys. Super happy to be here once again. And today I have a really, really special guest, Orlando. Super happy to have you here. I think that today we're going to discuss over topics that are well known for decades. We're going to speak about Black-Scholes and various mathematical equations that leads the market now. And we're going to, I would use the word disrupt just because this is what you have told me when we were having the introduction call. But today we're going to dive deep into the most fascinating equation and the most well-known and the most famous one. And we're going to dive deep in a way that will be very, very interesting. And I'm very, very happy to have you here. It's a great pleasure. And yeah, how are you today?
Afek, great to be here with you. Just to put kind of
Pleasure.
everything into context, I'm not a mathematician or a scientist. I do surround myself with the smartest people I can find. So I have a small team of STEM PhDs. I also recently joined the Martingale Foundation here in the UK, which provides scholarships to excellent students in maths and science to do their masters and PhDs in um, in STEM subjects. I've been around this. I've also been around kind of highly complex financial models now for 25 years, particularly over the past 20 years. And it's been my curiosity and my experience that has taken me down a journey of saying, where do the models work and where do they break down and where are there inefficiencies in the market?
Yeah, it's completely fascinating subject. Now, just look, I'll direct a question right now that will throw us back to yourself and to your own story. But why didn't you went to school and learning mathematical and learning STEM subjects in
I'm just not
in the right hand?
I'm just not that smart. I've been around a wide range of PhDs, and my brain, I think, functions in a very different way. My parents are artists. I went to boarding school when I was very young. My family come from from Hungary, and we have a range of academics and artists, and also some people that have gone into business and consulting. But I think what I've learned over time is, my brain is wired a certain way. I'm deeply curious. I'm very broad in my interests. I used to read quite a lot of fiction. Now I read a lot of nonfiction. I read a lot about politics and history, about things like the Silk Roads, understanding the way that the global economy, the way global geopolitics has come together. Um, and then over the span of my career, I've lived all over the world. I've traded global markets, probably with the exception of emerging markets. And I'm a curious person, but my skill set is quite different, hopefully complementary to the maths and science people that have worked in my teams.
I got it. It's very interesting because I like because of the podcast I surround myself with thousands of people that I speak with every single month, with hundreds. I would fix myself because it's impossible to speak with thousands, and I discovered that there are some great and very clever people who did not come from STEM background, and they're very, very successful, and there is no like there's no necessity to actually go to STEM background and to come up with a STEM background just to outperform or trying to outperform the markets. I think it's a very negative or a very misleading um, approach or even an assumption.
Yeah. So an observation I can share is that as we've met more quants who've worked at the largest firms, one of their criticisms or their concerns about that environment is that people are very siloed, they're very competitive, um, they don't share ideas, that the environment is not as collegiate. And what we found, what has been our success thus far, and I suppose some of the successes I've had in different areas of investing and in quantitative finance, is how do you bring the ideas together? And that might be partially because I'm in credit, and credit has a range of challenges that you don't have in interest rates or in FX or um, in government bonds, in commodities, in futures, where the
Obviously.
data is clean and transparent and readily available. So in credit, we have a lot more discussion about the quality of the data, the gap risk, how you deal with kind of the more extreme situations. So, we're much more exposed to left tail risk. We don't really have so much exposure to right tail risk. We do because we've moved into convertible bonds, but on the whole, credit investors focus very much on the left side of that tail. And they also, a lot of quantitative finance that is used in credit is built around option pricing and the mathematics. And the credit market really struggles when it doesn't have any answer. And rather than accepting that we have a terrible answer, a lot of mathematicians say, well, let me just recalibrate my model. Um, and so, yeah, one of the successes we've had is sharing ideas, cross-pollinating, breaking down the silos between equity and credit, between cash and derivatives, and sharing that ideas and saying, how can we find a non-consensus approach? How can we find new ideas to focus on the investment opportunities?
Brilliant. I would like to tackle the first thing, which is the data reliability in credit. I would like to ask you why it's so hard to validate the data in credit, and what have you done in order to prepare you to train your models?
So, uh, I mean, the basis of the problem is that the market is an over-the-counter market. So you're not trading on an exchange. So there is not an official traded price, a last price that you get in stocks and in futures and even in government bonds. Most of it is traded electronically, and there's a very clear reporting of those trades. In the US, the market benefits, excuse me, benefits from trace, but Europe's been very slow to catch up to that protocol, as has Asia, has emerging markets. So you do not have publicly available information on a tick by tick basis for credit. And it's felt like post the financial crisis that banks have actually tried to become greater gatekeepers for the market. So as the amount of capital in credit has expanded significantly as a market, but the market makers have shrunk significantly, so their inventories have fallen significantly. And at the same time, we've had the rise of the quantitative market making firms. The importance of data has risen exponentially, I should say. Um, and yet the
Why,
same.
why, why, why do you think that the importance of the data is rising exponentially? Like, what are the main differentiations between let's take a couple of years ago till nowadays, and what have been changed? What's new to that data feed that makes it so different?
uh, to give you a very simple answer, Jane Street.
Okay, let's discuss that. Let's discuss
Jane
a little bit
Street
about that.
changed the world when it comes to credit.
Okay, and what do you mean?
So if you look back at the market leaders in credit, and that then became total return swaps, TRS, and then it became ETFs. Um, the volume of credit trading has moved from bonds to CDS to index, so iTraxx and CDX indices. Then it moved to total return swaps, and then it moved to the ETFs. And credit as an asset class is being quite widely proven to not be high in alpha as a long-only product. Investment grade is very weak in delivering alpha. High yield is better. Convertible bonds is much better. And there are other areas within credit that, such as municipal bonds, that lend themselves to higher alpha strategies. But on the whole, credit is an asset class that is inconsistent. The data is often difficult to observe. The data is often dirty. It's prone to gap risk, liquidity changes. And what a firm like Jane Street did that the banks were slow to take up was that the technology now allowed you to capture, clean, and study data, build algorithms that could price securities and derivatives like an ETF more efficiently than a trading desk. So in the old days, when I started, you used to have a trader for every sector, and you may have one trader in investment grade and one trader in high yield. Some desks had a cash trader and a CDS trader. Other desks had one trader trading both instruments. And then when you used to price the index, every single trader would price the individual components, be that a bond or a CDS. And I used to do a lot of this when I was building CDOs and CDO squareds and CPPIs back in 2004 to 2007. So we used to have to collect all of this data relatively inefficiently it wasn't done as quickly as it needed to be done. And then we gathered it all, and then we did things like a weighted average spread to find out what was the value of that portfolio. And what happened post-financial crisis, the market changed significantly. We then had the European debt crisis, and since then we've had COVID and now tariffs. And firms like Jane Street across the board, and we can see it in government bonds, we can see it in FX with firms like FTX, XTX, I should say, excuse the Freudian slip. But these firms have recognized that if you capture the data, you study it, you use algorithms, that you can more efficiently, more successfully deliver higher risk-adjusted returns, higher consistent profits by pricing the underlying securities and the ETF or the derivative. And so Jane Street.
Because what? Because how do they discover that you can have higher returns, higher yields to price the underlying asset for an OTC one?
So they can more accurately and consistently price each of the underlyings that is in the ETF, and
Like
then
in a separately pricing each
correct.
asset.
So when you're building an ETF, you've got however many underlying securities. Let's call it 1,000,
Correct.
right?
Okay.
And so in order to have the most accurate idea of what the NAV, the net asset value of that ETF is, you need to price all 1,000 securities. But in credit, not all 1,000 securities are trading on a frequent and observable fashion. So from a mathematical perspective, you have to start doing correlations, and you have to start mapping the securities. You have to do things like on the run versus off the run. You're obviously doing modified duration. You're doing basis. You're doing a lot of mathematical kind of calculations. But what the real
In
the
order to group the assets and to price them in a group format, not to price them in a separate mode.
Correct. Yes. So, I mean, we've been doing this in fixed income for decades. It's something that was very much done in government bonds back in the day with a spline model of saying, this is where the on the run, this is the off the run, these are the securities that have convexity and that don't. And you map the whole kind of line, the whole group of bonds, and then you say, okay, if the 10-year treasury moves by 10 basis points, what does the off the run and what does the kind of the oldest off the run that is now highly illiquid and is being bought back, what is the difference in spread or in price between each security for a 1 basis point move in the market?
Mhm. That's
Now,
very interesting.
so where we are today is that people such as Jane Street have said we can take cloud-based computing, we can use Python codes and others, but Python in particular. We can hire people just like Renaissance did. We can hire people from a STEM background. We can write codes and algorithm. We can collect the data, and we can consistently and accurately price the securities and therefore price the ETF.
It's very interesting. Like the way that you say it, forces me to ask you a question about the the inefficiencies, and how do you actually locate and detect those inefficiencies correctly and try to build a plan in order to figure it out how you can make higher yields and higher returns from that asset. And we're speaking about a decade or a decade and a half ago and till nowadays, and we're actually making the comparisons in between the two periods, and we see that there is a significant change each and every single time period, that make the market much more efficient. Now, I would like to ask you, based on your experience, how do you actually recognize market inefficiencies? Like, if you were big, what would you do to recognize and to detect those market inefficiencies? What would you do? How do you prepare yourself with the right team, with the right capital, with the right I would say capabilities in order to resolve that inefficiency in order to make higher yields and higher returns?
Well, that is the golden question.
The Holy Grail. Yeah, I
That
knew
that
it.
that that is the holy grail, and this is where
But
people
this is not like, this is
this is
much
where
more
people
like a magic.
well, this is the confluence between art and science. And this is, for people from a quantitative background, this is where I would really encourage people to be more open-minded, and look at a wider range of disciplines than just maths and science. Because when you listen to Eugene Farmer, he says very clearly that these are just models that provide estimates. He is not making an argument about the efficiency of markets. He's saying this is the starting point, the efficient market thesis. And then you have to understand where on the curve you are of market efficiency, right? So if we go to corporate large cap equities in the US, that is a much more efficient market. When we go to Europe, it gets less efficient. When we go to Asia and emerging markets, it gets less efficient again. In credit, it's the same thing. US investment grade is a more efficient market. European investment grade is a little less efficient. US high yield, European high yield, Asian emerging market high yield, it becomes less and less efficient as the market becomes less consistent, less observable, where the rule of law is not consistent. And we have that problem even in Europe as the further we go east. The quality of going from common law to civil law to greater corruption, greater inconsistency, and then we go to markets where the rule of law is not compelling. Is
Hmm.
certainly not consistent. And that matters when you are trading a security because, whether it is a country defaulting on its debt in Latin America, or problems in Lebanon, more recently, or Egypt, or corporates that go bankrupt and then you go into a restructuring program, and the ability of investors to predict, to give a probability of default and to have a loss given default and the timing of default and the recovery. Um, all of these things are important in your analysis. And from a quantitative perspective, part of the problem comes when people believe the numbers too much, when they want to say, and this is kind of goes
What
to,
do you mean? What do you mean from a quantitative perspective? The numbers are too much because it gets harder when you have uncertainty in the world to actually to have like a defined probability of what will happen or an expectancy. So
I'm not sure if the uncertain, well, I think that that's more of a comment about the fatness of tails and the skew between the left and the right rather than uncertainty. Uncertainty in itself is not, certainly we don't think it's a problem. As long as you say, we expect that volatility is going to go up and down, just like the price of a bond or a stock, volatility goes up and down. If you watch MicroStrategy over the last year, it's gone on an incredible ride, and you see changes, there's really important pivot points, or focal points such as the slope and the skew that give you real information as to what's going on and where the demand is for risk and for hedges. So it's understanding, you ask this, you kind of you ask the holy grail, and my answer to that is you have to be willing to question the data. Data is clean and it is dirty. Data is well, securities are liquid and illiquid, and liquidity is not constant. So in equities, you look at the ADTV, the weighted, the volume of shares traded on a daily basis. You look at the
right,
VWAP, and you've got a clear measure of the daily liquidity and how that changes from day to day. But in a lot of,
because the liquidity on equities is much more consistent
yes,
or
it's
not.
consistent, but it's more observable, is the point that I'm making.
It's more accessible.
Correct. For no money, you can go onto the NASDAQ website, and download the open, the high, the low, the close, and the volume. And suddenly, you've got a treasure trove of data over years. So you don't even need a Bloomberg terminal for that. I've heard people on similar podcasts talk about the value of corporate actions. Quite a lot of day traders, and young quants, as they're building systematic strategies, will go in and try and extract the data and clean it and study it. And corporate actions is one of those areas that's quite difficult to piece together. And if you have that, then it potentially provides you with an edge. So, that, I suppose that's the other word that we haven't mentioned thus far. And that's really the crux of the matter is, can you develop an edge? So let me try and answer a couple of questions together. We believe that the efficiency of markets is it should be viewed on a spectrum, on a curve, and markets probably become exponentially less efficient, as you move into credit, into less liquid securities like distressed or ABS, certain emerging market bonds, a range of other securities, long dated out of the money options. Again, that becomes very inefficient, and Black-Scholes doesn't work for those types of options. So, that you have to understand that we are on this curve, like kind of almost up all parts of finance, and you have to understand whether your data is clean or dirty, the quality of how frequently it can be observed, and then you can start thinking about how the relationships change between the capital structure or across asset classes.
I got it. And I would like to tackle on a very on the same perspective, to be frank with you. You said that over time the market gets less efficient, and you said that there is a spectrum that you need to align with in order to understand like the I would say the direction of the market, or the rhythm of the spectrum. And you say that as long as the market gets less efficient, you would have to align and adapt yourself in order to find, or in order to discover or recognize parts of the market that you can adapt to, and find out an edge. And I would like to ask you, Orlando, um, as time goes by, how do you actually able to adapt yourself to those emerging markets, and to uncover new data and new edge that you can extract out of the data, and how it's like how the quantitative game overall gets efficient, as long as the market gets less efficient.
Sure. So I suppose an important point to make is that I think of market efficiency as being volatile. Every day the level of market efficiency goes up and down. It actually can go up in a single day. We've just seen these huge swings in gold and silver. And so, the ability to trade those securities, the price discovery, the information, it is changing at all times. And with more volatility, you get more efficiency, more and less efficiency, depending on the security. So I think it is, rather than having a staunch view of saying markets are efficient or markets are inefficient, of saying it is on the spectrum, or it's on this curve that I was talking about, and being open-minded and understanding, and this is, I suppose, my own experience and how I can apply it, of going through so many financial crises. My first one was Russia and LTCM. My first one managing money was 9/11. That was the first week that I was actually managing a portfolio and watching the planes crash into that tower and the tragedy that happened, and thinking about, how do I protect the money of my investors? You've got a moral issue, as well as a fiduciary issue, but the market efficiency changes frequently, and it's particularly bad in fixed income, and even more so in credit, where you have these structural problems. And so from a quantitative perspective, you have to be honest. You have to be really intellectually honest. You have to be curious and say, is that data clean or is that data dirty? Now, let me give you an example of what that means. If I get a price from JP Morgan for a credit default swap, I know that I can trade that price on the bid or on the offer for a set size. And JP Morgan is going to be very consistent. If I go to a marginal bank, kind of more in the east of Europe, or in the Middle East, or in Asia, and ask for the same price, it's not going to have the same size, quality, and consistency as a market leader like JP Morgan. That is just a fact. But from a quantitative perspective, if I ask two banks for a bid in 5-year CDS in INEOS, then I can mark down, in my spreadsheet, in my database, that those two banks gave me a bid of this number of basis points. And a lot of quants don't realize that those two pieces of data are not the same. One of them is tradable, is consistent. I've got a good idea of how that trades, even under stress conditions, where I can promise you from 25 years in credit, when I call a marginal bank, when the market is highly volatile, it's either no bid or bid to lose. And so the quality of their data is dirty and inconsistent. But in a database, you don't see that.
Hmm.
So this
Well,
goes to part of what I was talking about with inefficiency. And one of the experiences that I've had with quantitative analysts or the quantitative approach is that people do not know enough about cleaning the data, and they don't really want to engage in that idea. They don't think it's intellectually stimulating from a mathematical perspective. It's not like building a Gaussian copula. It's not like building a physics-based approach to studying billions of points of data. It's not an
because
interesting
it's
idea.
non-stationary.
Sorry?
It's non-stationary. It's not a thing that it doesn't have a one morphical truth for collecting the data, because
That's
like
right.
a physics approach might be misleading like in advance to
yes.
tackle that problem.
Exactly. So there is no golden record. It's not like an equity where you can say 100,000 shares just traded at this price with that timestamp,
Mm.
right? So equities, that's what we're allowed. But you have a look at European equities with all these ridiculous little exchanges, and so you're getting people trading odd lots here and there. Or in Germany, they seem to have an unlimited number of local exchanges, so the same shares with different tickers trade all over the place. It's absolutely ridiculous and inefficient. Um, Even across Europe, that we have multiple stock exchanges with different withholding tax rules and different brokers. So, that's an example of why Europe, there's a wide range of reasons why Europe is less efficient than the US, but the data is less, even in equities, European data is less observable, dirtier than in the US.
I got it. I would like to go further more in that subject of understanding data and how to clean the data. But let's say that price is a symptom, okay? And understanding the underlying cause is the most important thing, because without understanding the underlying cause, you cannot really, or this is like my perspective now. But without understanding the cause, it will be very, very hard to clean the data, or even extremely hard to understand it. So I would like to ask you, Orlando, how would you how would you actually uncover the cause? Because like let's take an hypothetical asset, you would choose it, and I would like to discover with you, how would you actually extract the cause? How would you actually understand the participants? How would you actually analyze the market in order to figure it out a way to clean the data properly?
So that's skill and experience. And so this is what
Art and
mathematicians.
science, the confluence of art and science.
Correct. This is exactly that confluence,
I'm
and
using
this
your
is
codes, you see?
yeah, exactly. And I think this is where people have to be really thoughtful, and they have to be curious and open-minded of saying this is not purely a mathematical scientific problem. The solutions aren't based purely in the data. If there you can apply a mathematical rigor to these situations, but if you don't know how to stress test them, it's things like, for example, VAR in credit is hugely problematic and challenging. It's really pretty flawed, and even at some of the
Because you
largest
cannot do the proper sorry to interrupt, because you cannot do a proper stress test, although
correct.
you can go mathematically rigor about it.
Well, the problem again is the data. So in
You don't have much of it to do a mathematical rigor stress test, or even more.
yeah.
Okay.
So, well, you don't have dynamic data. So one of the points that I would make.
So we have spoken about VAR and credit issues and how it's like even if we're going with mathematical rigor stress test, it will be literally impossible to do it on credit and on OTCs assets because there is not much data to do it properly. And I would like to ask you, how would you still able to clean I would not say clean the data, but understand it, make the data interpretable and generalizable for you to understand how to extract the right cause in order to find an alpha, or just to understand how the asset works to build upon it the alpha. I
Yeah.
would I
And
would
and
fix myself.
and so one of the things that has brought me to setting up my current hedge fund was the experiences that I had going back to 2004 and through the financial crisis and then through COVID. And what surprised me is that the market has actually gone backwards since the financial crisis. So we used to have more securities, we used to have more observability, we had more data, we had higher frequency, we had more electronic trading systems in things like credit default swaps. And the market has shrunk in many ways. It's moved into areas like ETFs and total return swaps. Um, and at the same time, when I speak to my peers and I ask about VAR and stress testing, they will tell me that their risk managers still use end of day pricing. And that to me has always been a huge concern because the end of day mathematically is just a random point in time, right? So it is not the open, it's not the close, it's not the high or the low. It's just saying that is when we get a data file from a third party provider. And then based on that input, we run the models. Now, if you are trading the crossover index, the high yield synthetic index in Europe, and it has a 100-point range in the day, but opens and closes at the same point, then you observe no volatility
And that
mathematically.
causes a significant problem.
And that is a huge problem because
It's a huge gap in the data.
your P&L has swung around by a huge amount of money during that day, but from a model and a mathematical perspective,
You have nothing. You have no evidence.
there's no P&L and there's no volatility.
So how do you extract the data from it?
So I'll talk less about what we do now, but I'll go back to what we used to do in credit default swaps, which is where we started. So we said rather than just relying on a third party to provide us with data at the end of the day, we are going to try and collect as much data as possible dynamically. So we're going to say no matter how frequently the banks send out information, we're going to try and keep track of that. We're going to try and keep track of which banks send out a lot of prices, what happens to the prices during a period of stress. And
Mhm.
then particularly in the US, we have trace. So we can actually observe what printed, how frequently did a bond price, um, you know, and what was the nature of that type of trade. So there's all of this additional information that's available. So I think trying um, to build a clearer picture of what actually transpired. So I suppose part of the difference in what we do is rather than saying I am a genius, which I am certainly not, rather than saying I am the alpha, which is the usual pitch for a hedge fund. When a hedge fund is pitching, the usual line is I can beat the market frequently while controlling risk, and that is alpha. What I've observed in my career is that is often actually leverage beta. That is prone to gap risk. That's prone to disastrous outcomes, which we've seen in all of these crises, but a range of other situations. So we wanted to move away from talking about what we think and focus on what we know. And
Mhm.
what we know cannot be based on dirty data. It needs to be based on clean data and consistent and observable. And we have to do things in a way that mathematically, scientifically, um, meets certain rigorous standards.
I understand. Um, You said that there is a thing that stresses you, and this is that people are still using end of day pricing, and it's very prone to the inefficiency in a way that you cannot really understand uh, uh, literally anything that still holds behind. And I would like to ask you about doing stress tests and about doing value at risk assumptions for those data files in order to have a reliable distribution that you can count on and you can understand what the data is telling you because I don't know, I'm just questioning you, but how does a stress test and how does VAR systems enable you to understand data for exotic assets as we're speaking so far?
So I think it's about scoring the quality of the data. So going back to my point of about
Scoring the quality
scoring,
of
so you need to be
what do
able
you
to
mean with the term score?
so you need to be able to say what data is dirty and what data is perfectly clean, what is pristine and what is a total disaster, what's a mess, where does the data not really mean anything?
How
Um,
do you make an engine that will separate the data into those two gigantic buckets?
Well, you can test it. So you say, okay, the data is telling me this. Is it true? So one of the areas that we
So
like,
you're still questioning the data.
yeah. So you need to you need so this is where you
This is
can
a necessity to question the data.
well so you're so in our case, I have a theory. And I share that theory with my analysts, and they go and we discuss what data they're going to collect and how they're going to clean it and how we're going to study it. And I'll say to them, I have a theory about CDS or ETFs or distressed credit bonds. And can we get sufficient data to test that thesis? And can we then look at the way that that thesis works over time? Because I don't think the problem so much is that on a static basis, you can always find a point in time where your thesis holds. The problem becomes what happens during different market conditions. So, and this goes back to the whole idea of normal distributions and normal functioning markets. But as we are getting with more financial suppression that we have seen from central banks, so we have lower volatility over time and bigger spikes in volatility. And I suppose that potentially they're more frequent. I don't actually have the data on that to to support that thesis, but my experience has certainly been that we've seen central banks over the last 30 years do more to protect the financial markets and the global economy. We've obviously had quantitative easing, zero interest rate policies. We've had a lot of very unusual policies, and these create even more inefficiencies in the market. Um,
I wish to stop for a moment and to ask you about quantitative easing. How does uh, an event like quantitative easing impacts the reliability of the data and how and the central banks know how to time the know how know the perfect time to to place quantitative easing, but I would like to ask you how it actually impacts yourself with understanding the data to prepare a thesis and to give it to your analyst and to build upon it. Um,
Well, I would disagree with you strongly that the central
oh,
banks have perfect timing on anything.
yeah, but they know how to place their tools in order to stabilize to stabilize everything. No?
um, I mean, we've got a new nominee for the Fed who is going to argue the opposite of saying, central banks have been much too involved in the market and their mandates have broadened and they've ultimately done significant damage to the global economy. Um, my personal experiences have been that central banks have failed to recalibrate. They failed to understand inflation during the COVID era. They still use economic models, and economics is almost the biggest kind of the central problem in all of this, because economics is purely an art. It is not a science at all, and that it is still taught as a science is a joke. It's ridiculous. There is no science in economics. And that is part of the flaw of saying, okay, and it's the same thing in some of the finance parts of going, okay, we have to understand that there is an element of science and there's an element of art. And you hear that from many of the great traders, and even from the Jim Simons type of people. He talks about how seeking beauty. So he says you want to surround yourself with brilliant people, but you want to seek something that's beautiful, something that is different, something that's interesting. Now, that's not necessarily what you frequently hear from people in the world of central banks or in quantitative finance, and certainly not in economics. So, you know, to answer the kind of the question, quantitative easing is just another distortion that happens in the market. So if the central bank becomes the buyer, the main buyer or the buyer of last resorts, then they skew the market. And that data then goes from being cleaner to becoming more dirty, and it's more subjective as to what that data means. So if the ECB is buying a load of triple B bonds, that affects the spread between triple Bs and double Bs, between investment grade and high yield. And so that is actually creating less efficiency and more distortions in the market, and the quality of that data deteriorates.
Mhm. And still, when the quantitative easing is a pretty rare, it's a pretty rare occasion, and I would still want to throw us back to the question that I was asking previously. I would like to ask you about doing proper stress tests and doing proper and using properly VAR systems in order to understand the probability of the data, and in order to understand the story or the understanding behind what the data is still saying to you. And we stopped when you started to talk about quantitative easing, and you said that until you have like a rare event that the central banks are actually forcing the market just in order to stabilize it, um, there's still a proper way to understand this data. And I would like to ask you, how do you understand this data without like having all those stabilizing tools that the central bank is forcing the market in order to stabilize?
Well, it goes back to the stress testing. So you need to understand what data is tradable and observable, and what's consistent and what's not. And so the end of day methodology is consistent, and you've got a golden source that sends you that, and you say, we will do the same thing rigorously every day. And so the confidence around our 95 or 99% VAR is higher. What I'm saying is that process can be flawed or undermined by that approach of using data at the end of day rather than saying, let's use a stress test that uses the wides of the day or the tights of the day, because you could be long or short. So you need to know what was the worst case scenario at any point during that day in order to have the most accurate view of your value at risk.
Mhm. Very interesting. Very interesting. Now, I would like to jump over the next topic um, that I really want to discuss with you, and it's Black-Scholes. When we had our introduction call, you said, "Hey, there is a certain problem with how Black-Scholes is being approached nowadays, and and I would like to question you." And give the stage for you, mate, in order to understand what are you actually trying to say here? Like, what's your I would say declaration about Black-Scholes and how Black-Scholes still needs to be validated nowadays according to your approach.
Yeah, so I don't think the problems with Black-Scholes are new. So, when you look at Edward Othorpe, who I believe had actually developed and started trading the Black-Scholes option pricing formula prior to Black-Scholes. They published it, but he'd already been trading it for quite some time, very successfully. And so it does a very good job of giving you a good estimate for at or around the money. Let's call it 90, 110, maybe 80, 120 moneyness, and out to certainly kind of shorter maturities, 3 months out to a year, but the longer duration and the further you get out of the money, the deeper in the money you get, the less accurate the Black-Scholes model becomes. So all of the assumptions that are built into the Black-Scholes model, they cause greater problems with further away in moneyness and longer duration. And what most traders or most quants will do is saying, okay, my solution to that is I'm just not going to trade those securities that don't fit within the model. And so when you start building your vol surface, really what you're doing is it's actually a much narrower vol surface. You're saying, okay, between 80 and 120 moneyness, between 0 and 2 years, that's my vol surface.
Hmm.
But for people like me, we're functioning in a much longer duration and a wider range of options that are deep in the money or deep out of the money. And so, our
Getting
vol
still getting deeper.
surface has to be much bigger, much broader,
Mhm.
and we have to deal with
You have
options.
to go in the money.
Well, you have to go in or out of the money, and you have to say what happens beyond 2 years in duration.
Mhm. So
And
that mathematical accuracy makes the difference between having an alpha or having an edge to not having an edge at all. If you're not going deep into the money, you're having like a very gray zone that you don't really understand what's actually happening. Is that correct?
Well, I would just talk about it in terms of market efficiency. So if you are pricing a 3 month at the money option, the market's pretty efficient. If you are pricing a 5 year, 100 or 200 or 300% out of the money option, then it is very inefficient. So
Hmm.
the observability of that option is very low. It's infrequently traded. The bid offer spread is very wide. So and your ability to get in and out of that security is very low. So that data becomes very dirty. The theories totally break down. I mean, Black-Scholes already has some very well-known flaws, even pricing at the money 3 month. But because that's the market standard. It works. Everybody prices and it's pretty consistent. I have a friend who's making a fortune trading zero-day trading options in S&P, and he shows that actually there's a huge amount of inefficiency in zero-day. So, at both extremes, because zero day is a relatively new market, because there's lots of retail, there's lots of speculation, you can actually find inefficiency there. Um,
Very, very easily.
well, no, I mean he's
So
built
it's
he's
still
built a whole framework. It's very quantitative. He's spent years building his analysis, but the alpha is there. It's just required, again, some creativity. It required going and collecting and cleaning data that others have ignored, and going to an area that may be niche or misunderstood by the market.
Mm. and and you say that there are a couple of quants that would say, okay, I'm not trading those securities, but you still tend to go furthermore into calibrate the Black-Scholes to your needs in order to be in the money or out of the money, and just in some occasions. And I would like to ask you, how do you make sure that you calibrate the equation, or not you the people that you work with, and how do you collaborate together this equation in order to be able to trade that security?
So we use unconventional methods. So we use more of a mathematical and scientific approach that is not based on the theoretical model. So we study the data, we look at ways that haven't been used before in order to price the value of an option and to
It all goes back to the data. Like the calibration of the equation goes all back to the data.
correct.
Okay.
So rather than saying we have a Black-Scholes model or a jump diffusion or a modified Merton model that makes certain assumptions, um, and they also require inputs, and those inputs, everybody has a different view of what's the future level of each of those points. So, when you're starting to move away from the core thesis of Black-Scholes, that you have a normal distribution of returns, that the risk-free rate is stable, that volatility is at one level rather than having a volatility surface. All of these factors that are well known, you move away from that and say, okay, let's look at each of those different elements. So the normal distribution is the easiest place to start, of going, okay, there are some assets that are more normally distributed, and there's some assets that are less normally distributed. There are some that are highly skewed, that have a strong left tail. Sometimes the skew moves, like MicroStrategy has frequently over the last 18 months, where it's had a strong positive skew and it's had a strong negative skew, and it swings around it, as does the slope. Slope's another one that it moves meaningfully. So just looking at the single points can give you a very deceiving idea of what's actually happening.
It's very interesting because people will tend to do the and I think that I'm one of those characteristics that I'm speaking about is that they tend to take an assumption and test it. And you say no. My assumption would be totally built upon learning the data and learning the skew, learning the tail risk, learning the data of the security, and that will help me to minimize or to mitigate like the amount of assumptions that I have in order to fine tune and calibrate the equation, which is very great point that I will take far from here. And I do would like to ride over that topic. I would like to ask you how it's like being very very familiar with the markets and knowing like all the different aspects and understanding the financial markets to the deepest roots that you can actually go. How it's like transferring this understanding to your quantitative peers in order to explain them your thesis and in order to derive the rightest considerations. How like what do you do in order to explain them what do you need, what do you want, and how do you build and how do you orchestrate your thesis um, to make it clear for those people who doesn't have like the deepest roots as you do?
So I suppose this goes back to my family values and the way that I was brought up. You know, I'm very much a believer in meritocracy, that everybody contributes to the success of the business and the team, that everybody's view has merit and is worthy of consideration. Obviously, different people have different strengths and weaknesses. I'm a very big believer in cognitive diversity. So, you know, to take it to the kind of the more kind of to talk about diversity and inclusion, but my experience in finance has shown me that if we have more people from the same background, with the same education, with the same interests, we're going to build a consensus. And we're not going to stress test it in the same way. And we're not going to think about what could cause us significant losses, and be more open-minded to changes in the cycle and breaks in the system. So I value, as I said, meritocracy, diversity, and very open communication. So I have a very clear dialogue. There is no hierarchy in our business. You know, we come together. We try and make it as academic as possible. So we say, you know, let's have an open discussion. It's very important that people know that it's okay to make mistakes. What's not okay is to not acknowledge those mistakes and to not learn from those mistakes. I think George Soros kind of was the best kind of exponent of that, is saying something along those lines. So I've tried to learn from market leaders like him and say, you know, we have this open dialogue. We don't have any hierarchy. You know, we're purely based on merit. We like diversity. We want different ideas. We want new ideas. And we have this open communication from different perspectives. So when we started this hedge fund, we spent time looking at quite extreme events like distressed securities. And I said, well, I've been trading these. I'm not a distress specialist. I'm more of a credit specialist. But I've traded these situations through a range of financial crises. And this was my experience. Could you go and collect the data, and could you clean the data and study the data to tell me if my thesis was right, or if it was right some of the time, or what percentage of the time? And what is fantastic is they were able to come back to me and say, these are the facts. So we're no longer talking about what I think. We can talk about what we as a team know.
Mhm.
And this is something that I haven't experienced all that much in quantitative finance. Of a lot of quants that I've worked with would go, no, I don't want to have. I'm not interested in that conversation. There's two things that are usually the factors. They say, usually, I'm happy with the models. I'm happy with my mathematics. And the way that we are going to beat the market is with me as an individual, or potentially me as a team. And, you know, I'm trying to move into a different direction of saying, our ideas and our experience are the core foundation of our alpha. And then we go and build build kind of our database, what's become a data lake. We study and capture the data so that we can identify alpha that other people have often ignored or they think is too niche to try and harvest.
For managers and directors to have like a very open conversation, it's very deep in their roots and understanding of how communication is supposed to be built. But when actually intervene like other people and it doesn't really matter their cognitive level or their cognitive understanding, it makes the conversation much more inconsistent. And I still would like to ask you, how do you build the right team? uh, um, it's more of a startup conversation that I'm trying to direct the conversation to, um I would like to wonder with you, how would you actually locate the rightest candidate to align with you, like as a person, as a personality, in and how do you build the rightest communication in order to extract the most of the value out of it?
So I suppose leading by example, and building a strong culture. So in my case, that culture is about meritocracy, inclusion, diversity. We have been very elite, because of all of my weaknesses and flaws. I especially try and surround myself by the brightest people I can find. So I started hiring STEM PhDs from Oxford in 2019. Most of the people that have been through our PhD program have studied at Oxford. Our current PhD intern actually studied at a different university, but has been a great contributor to our team and comes with a range of ideas that have been hugely complementary. He also studied physics, but a different strand. Physics has been a particular area of success for us, but we look at chemistry and biology and engineering and pure mathematics, a range of other STEM subjects. But culture, and I think leading by example, I've made significant sacrifices. I've invested a significant portion of my own wealth to build the company, to get the fund up and running or the strategy up and running. I've supported charities, with both my time and my money. I've now joined the board of this foundation that provides scholarships to people, to excellent students from
The Martingale Scholarship,
the Martingale Foundation. Yes, that
the Martingale Foundation.
they provide scholarships to people from low income backgrounds who have delivered excellent results in their undergraduate to study a master or a PhD in finance in the UK, in STEM in the UK.
Mhm. It's a very interesting topic, like building a team and orchestrating it properly and finding the rightest candidates that will enable you to thrive with them together. And I would like to shift the gears onto our next topic that I would like to speak about, and which is raising money and raising capital. I would like to ask from your perspective. Um, I would like to have a more of a deliberate conversation about raising capital and funding for a hedge fund. How's the process actually been managed? How to approach investors on the first meetings, and what's the most um, rightest what's the most rightest methodology to approach those individuals in order to have a serious funding round.
Um, I'm not sure I'm a particularly good person to answer that question. I run one of the smallest hedge funds in the world. Um, we've we've been very slow to scale and to prove our thesis. We've been very slow and deliberate. Um, I'm still very much on my learning curve. I've helped raise money as part of bigger institutions. I've raised some significant capital from family offices to do some more private capital ventures. But I think being very clear about what it is that you're offering is very important. So you need to know your audience. Are you providing a solution to a problem? Is that solution interesting to high net worth individuals or family offices or institutions? And within the institutions, what is the difference between a pension fund, an endowment fund, and a sovereign wealth fund, and an insurance company? What is the difference
But how do
between?
you understand their problem? How do you understand their desire by the end of the day? Like what they're most interested to invest in?
Well, this is also a big challenge because a lot of people take the challenge too literally. So they listen to what people say. I try and follow what they do rather than.
Those points. Follow what they do.
So, where possible. So Norges Bank, for instance, has a huge amount of literature on its website. So it talks about manager selection, and it talks about emerging managers versus established managers, and it talks about different asset classes. So, they are a market leader. The CEO has this incredible podcast that I'd encourage everyone to listen to. It gives you
What's the name of the podcast?
In Good Company.
Okay.
Um, so yeah, absolutely one of the best podcasts with market leaders, and he asks insightful and interesting questions. He's a brilliant money manager himself. He's now responsible for one of the largest, if not the largest, pool of capital in the world. And they they're they're very transparent, they're innovative, they're very interesting. So I think you in their case, you can read about what they say, but you can also see what they do. But in general, that's been my big lesson of saying funds are in the business of providing a solution. Understanding, do you have an edge? Are you providing a solution? Who does that solution fit with? Where are you in your life cycle? So, I'm an emerging manager. A lot of investors are not interested in investing in an emerging manager until the thesis is fully proven. Thankfully, we've come through the first few months, and we're now we launched our second strategy. It's been delivering outstanding results with very low
Congratulations.
volatility and a very high hit rate. So we're starting to get more engagement with institutional investors and separately managed account. People are looking at a systematic approach to credit and saying, is it scalable? Is it scalable? Is it sustainable? Is it clearly differentiated? Um, so you've got to know your audience. You've got to know what they're looking for. People have a very small attention span, so you need to be able to summarize what you're doing probably into 3 points. You have to have skin in the game. That's hugely important. A lot of people, don't get that. I've really struggled
I
with.
don't get it as well. What do you mean skin in the game?
Well, alignment of interest. So if you go to somebody and pitch them your fund, and their first question is, have you invested your money in this fund and this strategy? And if we invest our money with you, how much of your money? So this whole kind of other people's money, AUM revenue part of the business is totally upside down. If you do not have faith in you, if you're not willing to put your money, if you're not willing to go to your friends and your family and ask for capital at the beginning, if you're not really willing to put yourself on the line and say, I have an edge. I've stress tested this. I'm confident that when things go wrong, I can control the risk. So I'm never going to lose the money beyond this. And you've got to, even Ken Griffin, had a huge drawdown and had to gate the fund. This is a brilliant investor, one of the market leaders, but the financial crisis was so extreme that he had this huge drawdown and he had to gate it, but he was able to he was able to rise like the phoenix out of it. And he had a lot of skin in the game um, at the beginning. But for new managers, and even, I think even for more established managers, if you're not able to show investors that you are aligned with them, and this is, part of my concern around management fees versus performance fees is management fees should actually go down as AUM goes up, but the relationship is inverse. So, for Renaissance, they get bigger and bigger. They're taking 5 and 50. Then they close the medallion fund to external investors and give them some other strategies which haven't performed nearly as well, still with a high fee. Investors have the right to buy whatever strategy they want. But if you do not have skin in the game, it's very important to kind of look at to see look at the Black Swan, look at those types of books, and understand the markets, but also understand the psychology both of the markets and of individuals. And so something like having skin in the game is incredibly important.
Absolutely. Just one question to close this this very significant conversation, because I think that we have spoken about some various topics that can be very well taught in every for every hedge fund and for every listener that is still listening to this conversation till that point. And I would like to ask Orlando about the shift from being an emerging manager to the established manager. How do you shift yourself from the emerging phase to the established phase, and how do you do it properly enough in order to convince those investors, hey, I'm Orlando, now I'm an established manager right now. Now I already proved that I have that I put in everything that I can, and I very skin in the game, as you said. Now I'm an established one. I would like to ask you how the shift is being actually done on your end, in order to convince those LPs to provide you with money.
So the first part is to show that our edge is differentiated, that it's sustainable, and that it's scalable. We have to build a team that can support that, not just to develop it, but that can grow and support a higher amount of capital and more sub-strategies and more complexity. You also have to build operational infrastructure. So this is something that is hugely challenging for hedge funds, but particularly emerging hedge funds, is you have to build high quality infrastructure, whether that is the fund structures, whether that is the service providers, the regulatory oversight, the risk and compliance, risk being absolutely, potentially the most important. You have to build a team that, that it's bigger than the individual. So, a lot of investors prefer to have one principal. They don't like to have kind of a bunch of co-CIOs and co-principals, because ultimately the buck needs to usually stop with one person. They need to have that skin in the game and that alignment of interest. So you have to build the infrastructure. These businesses are meant for scale. The emerging manager has a range of problems, and those problems have actually got worse with the growth of the multi-managers, because most investors, most large institutional investors will say, I can just go and get that strategy as part of my multi-manager. Um, so you have to prove that you do have this edge, that you know how to scale the business, you know how to build the team, you know how to incentivize the team, know how to protect your IP, how to put in place strong regulation, risk management, compliance, strong IT. Um, IT security has become very important. And in cases like ours, the data, we've built a data lake, we've hired systems engineers, we've built a PhD program. Those are the things that we've built so that in time we can become, hopefully, if we continue delivering repeatable alpha, that we can show that is scalable and sustainable.
Brilliant, brilliant. Look, Orlando, that was a really incredible conversation, and I would like to thank you for the participation in our show, the Blushing Quants. I have learned so much from that conversation, and I will surely absorb more than I think I will from that conversation. And for those types of conversation, I do host a podcast because I think that like what we have shared, what you have shared today is very very hard to locate in the internet, and it's very 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 nice that we are able to present that data to the world, and I'm very very grateful for the opportunity to have you on the show. It was spectacular conversation, and thank you for being here. Thank you for your participation.
Afek, it's been great to be here and to spend the time. We hope to build our quantitative and our PhD team over the next few years. So people feel free to reach out to me. But it was great to have
I
this
will leave
conversation
your
with you.
LinkedIn. I will leave
Absolutely.
your LinkedIn link, and again, it was a brilliant conversation. So until the next time, thank you guys, and see you on the next episode. Thank you, Orlando.
Thank you, Afek.